August 23, 2000. Jeff Skilling stands on the trading floor of Enron headquarters in Houston, watching a stock ticker hit $90 a share. The company is worth $63 billion, more than Boeing, more than IBM. Fortune magazine has just named them America's most innovative company for the 5th consecutive year. If you walked up to Skilling that day and asked him what Enron actually made, what it physically produced, he'd smile. Because that was the wrong question. Enron didn't make things. It made markets. It made the future. It made, according to Wall Street analysts, pure financial genius. 16 months later, it was gone, bankrupt, evaporated. The fastest corporate collapse in American history. But here's what makes Enron different from every other corporate scandal you've heard about. This wasn't a story of hidden crimes and offshore accounts. This was a magic trick performed in broad daylight using tools that were perfectly legal, signed off by auditors, celebrated by the business press, and taught in business schools. The fraud wasn't in the shadows. It was in the spotlight, and the most unsettling part. The same tools they used still exist today. So let's pull back the curtain. Let's see how the trick was built, where the mirrors were hidden, and the exact moment the whole illusion shattered. To understand how Enron became a magic trick, you need to understand what it was supposed to be. And what it was supposed to be was actually quite boring. In 1985, Enron was formed from the merger of two natural gas pipeline companies. Pipes, that's it. Miles and miles of steel tubes carrying gas from Texas to wherever it needed to go. This was the utility business, predictable, regulated, the kind of company where growth meant laying more pipe and waiting for population to increase. You bought Enron stock for the dividend, not the excitement. But in 1990, a McKinsey consultant named Jeff Skilling had a different idea. He looked at natural gas and saw something nobody else did. Not a commodity flowing through pipes, but a tradable asset, like stocks, like bonds. Why couldn't you create a market for it? His pitch was elegant. Deregulation was coming. Soon, energy producers could sell to anyone. Buyers could buy from anyone. But that created chaos. Who do you trust? How do you lock in prices? What if you need gas in February, but it's cheaper in August? Enron, Skilling proposed, would be the middleman. The New York Stock Exchange of Energy. They'd create futures contracts, standardize trades, provide liquidity. Producers could hedge their risk. Buyers could lock in prices. And Enron would take a cut of every transaction. It was a genuinely innovative idea, and for a while it actually worked. By 1996, Enron had built one of the largest trading operations in the world. Their Houston trading floor looked like Wall Street, complete with shouting traders, flashing screens, and the controlled chaos of billions of dollars changing hands. They weren't just trading natural gas anymore, electricity, bandwidth, weather derivatives. If you could put a price on it, Enron would create a market. The stock price climbed. Analysts loved it. Skilling became CEO. Everything was working, except for one problem. One little crack in the foundation that would eventually bring the whole building down. Growth. See, when you're a traditional pipeline company, growth is linear. You lay more pipe, you move more gas, you make a bit more profit. Slow, steady, boring. But Enron wasn't a pipeline company anymore. It was a trading company, a tech company, the future. And companies like that don't grow linearly. They explode. 20% quarterly growth, 30%. The market expected it. The stock price demanded it. And to deliver that kind of growth, Enron needed something more powerful than actual profits. They needed an accounting trick. Here's how a normal company makes money. You build a widget. You sell the widget. You count the cash. Profit. Simple, honest, verifiable. But Enron wasn't making widgets. They were signing long-term contracts. 20-year deals to supply electricity to an entire city. 15-year agreements to manage energy for a corporation. These deals would generate revenue, sure, but that revenue would trickle in slowly over decades. Wall Street doesn't wait decades. Wall Street wants growth now. So in 1992, Enron received approval from the SEC to use something called market accounting for their trading business. And this is where the magic trick begins. Mark-to-market is actually a reasonable concept when you're trading stocks or bonds. Things with clear, observable market prices. You mark your holdings to whatever the market says they're worth at the end of each day. Fair enough. But Enron applied it to contracts that wouldn't pay out for 20 years. Contracts where there was no market price. Contracts where the future profit depended on estimates, assumptions, and forecasts that nobody could verify. Here's how it worked. Imagine Enron signs a 20-year deal to supply electricity to a city. They estimate this contract will generate, say, $100 million in profit over those 20 years. Under normal accounting, you'd book that profit as the cash actually came in. $5 million this year, $5 million next year. Slow and steady. Under mark-to-market, Enron could book the entire $100 million as revenue on the day the contract was signed. Day 1. Zero electricity delivered. $100 million in profit. You can see the appeal. Sign a big deal, get a massive earnings boost, watch your stock price soar. Analysts see explosive growth. The market rewards you. Your stock climbs higher. But here's the fatal flaw. That $100 million isn't real. It's an estimate, a forecast. A guess about what might happen if everything goes according to plan over the next 2 decades. And here's the thing about the future. It doesn't always cooperate. Maybe energy prices drop and the contract becomes less profitable. Maybe the customer renegotiates. Maybe costs run higher than expected. Suddenly that $100 million was actually $60 million, or 40, or 0. But you already booked the profit. You already told Wall Street you earned it. Your stock price already went up based on that number. So what do you do when the forecast turns out to be wrong, when reality doesn't match the story you sold? You can't take back the profit. That would crater your stock price. You'd have to admit you were wrong. That growth wasn't real. No. What you do is sign another deal, a bigger deal. Book even more future profit. Use those fresh imaginary earnings to cover the shortfall from the last imaginary earnings. And then next quarter, when that deal underperforms, you do it again, bigger, more complex, more aggressive assumptions. It becomes a machine, a perpetual motion device powered by paperwork. You're not earning money. You're manufacturing earnings, creating profit out of forecasts about a future that may never arrive. And the cruelest part, the better you get at the trick, the more the market rewards you. Your stock goes up. Your cost of capital goes down. You can make bigger bets, book bigger profits, which makes your stock go higher until you can't, because eventually you run out of plausible deals to sign. Eventually, someone asks to see actual cash. Eventually, the chickens you've been counting for 5 years still haven't hatched. But by then, you're in too deep to stop. The machine has to keep running, because the moment it stops, the moment anyone realizes the growth was imaginary, the whole thing collapses. So you don't stop. You build a second trick, one even more dangerous than the first. By the late 90s, Enron had a new problem. Actually, the same problem, just bigger. All these massive profits they'd been booking weren't generating actual cash, which meant to fund their operations, to make those future promises come true, they needed to borrow billions of dollars in debt. But here's the issue. Debt shows up on your balance sheet. And if Wall Street sees a company with explosive profit growth, but also massive growing debt, they start asking questions. Like, why isn't all that profit turning into cash? Why do you need to keep borrowing? These are good questions. Fatal questions. Enron needed a way to hide the debt, to keep the balance sheet looking pristine while the cash kept hemorrhaging. They needed someone clever, someone willing to bend rules. Someone who understood that accounting wasn't about truth, it was about presentation. They had Andrew Fastow. Fastow was Enron's chief financial officer. Brilliant, ambitious, and utterly ruthless. While Skilling was the visionary selling the story, Fastow was the mechanic under the stage building the trapdoors. His solution was something called special purpose entities, SPEs. In theory, SPEs are legitimate. They're separate companies set up for a specific purpose, legally distinct from the parent company. Corporations use them all the time for joint ventures, project financing, things like that. Perfectly normal, but Fastow used them as invisibility cloaks. Here's the trick. Accounting rules said that if an SPE was truly independent, you didn't have to include its debts on your balance sheet. The keyword independent meaning not controlled by you, funded by outside investors. Separate. Fastow created hundreds of these entities with names like Chuco, JD, Raptor. And then he did something extraordinary. He ran them himself. He was both sides of the deal. CFO of Enron, manager of the SPEs, buying from himself, selling to himself, moving Enron's worst assets and biggest debts off the books into these shell companies, all while personally profiting from the fees and management contracts. It was staggeringly corrupt, but it was also staggeringly effective. Here's how it worked in practice. Enron signs a deal that's already going bad. Under mark to market, they've booked huge profits. But the reality is this asset is worth far less than they claimed. Maybe it's losing money. Maybe it's worthless. If they admit that, they have to take a massive write-down, erase the phantom profit. Watch their stock crater. Instead, they sell the bad asset to one of Fasto's SPEs. The SPE pays Enron's inflated price. Enron books the sale as validating their original valuation. The problem disappears. But wait, where did the SPE get the money to buy this garbage asset at an inflated price? From banks, who loaned to the SPE, often using Enron stock as collateral. Think about that structure for a second. Enron sells its bad assets to a shell company. The shell company is funded by debt. That debt is backed by Enron stock. Enron stock is high because the market believes Enron's profits are real. But those profits are inflated because Enron sold its bad assets to the shell company. It's circular, the snake eating its own tail. The structure only works as long as Enron's stock price stays high. The moment it drops, the collateral loses value. The loans get called, the SPEs collapse, and all that hidden debt comes flooding back onto Enron's balance sheet. But there's an even darker element. Fasto structured many of these SPEs so that if Enron's stock dropped below a certain price, the entities would automatically trigger, forcing Enron to cover the losses with more stock, which would dilute shareholders, which would push the stock down further, which would trigger more SPEs. A death spiral hardwired into the company's own financial structure. And through it all, Fasto was personally making millions, 30 million by some estimates. From fees, from managing these entities, from side deals. He was looting the company while simultaneously hiding its decay. The pristine glass tower of Enron, the one Wall Street kept celebrating, was built on a rotting foundation of secret debts and fake assets. And the foundation was held together by a single fragile pillar, the stock price. As long as it stayed high, the trick worked. The SPEs held. The illusion persisted, but illusions are fragile things. And in the year 2000, someone started asking questions. Jim Chanos runs a hedge fund, but not the normal kind. Chanos shorts stocks. He bets against companies. He makes money when overvalued companies collapse. And in late 2000, Chanos started looking at Enron. What caught his attention wasn't a smoking gun. It was something simpler, something obvious, hiding in plain sight: return on capital. See, Enron claimed to be massively profitable, huge earnings, explosive growth. But when Chanos calculated how much profit they were generating relative to the capital they were deploying, the number was terrible, among the worst in the industry. And then there was cash flow. Enron's reported earnings kept climbing, but their actual cash flow, the money coming in the door, was stagnant, sometimes negative. For a trading company, this made no sense. Trading doesn't require huge capital expenditures. You're not building factories. If you're profitable, you should be generating cash, unless the profits aren't real. Chanos couldn't see the SPEs. The structure was too opaque, but he could see the shadow they cast. A company reporting massive earnings but generating no cash was like a building with no doors. Impressive from the outside, but how does anyone actually get in? He shorted the stock. And then, in August 2001, someone inside the building started screaming. Sharon Watkins was a vice president at Enron. She'd worked in Fasto's finance division. She'd seen the SPE structures. And she was terrified. On August 15, 2001, she wrote an anonymous letter to Ken Lay, Enron's founder and chairman. The letter was stark. I am incredibly nervous that we will implode in a wave of accounting scandals. She laid it out. The SPs were bogus. The accounting was aggressive to the point of fraud. The partnerships run by Fasto were conflicts of interest that would make any auditor blanch. And all of it, every bit of the structure, only worked if Enron's stock stayed high. Lay, to his credit, met with her, ordered an investigation. But the investigation was conducted by Enron's own law firm, who had helped structure the SPEs. They found nothing improper. Of course they didn't. But the whisper was out there now, and whispers have a way of getting louder. In October, Enron announced it was restating its earnings, wiping out nearly $600 million in profit from previous years, profit that had never existed. They also revealed billions in debt that had been hidden in the SPEs, debt that was now back on the balance sheet. The SEC opened an inquiry. The stock, which had been at $90 a year earlier, dropped to $30, then $20, then $10. And then the death spiral Fasto had engineered kicked in. As the stock fell, the SPEs triggered. Enron had to issue more stock to cover the losses, which diluted existing shareholders, which pushed the price down further. On November 8th, Enron's credit rating was slashed to junk. The company couldn't borrow, couldn't function. On December 2nd, 2001, Enron filed for bankruptcy. At the time, it was the largest bankruptcy in American history. $63 billion in market value gone, 20,000 employees out of work, pensions evaporated. The implosion Watkins had warned about took less than 3 months. The human cost of Enron is hard to overstate. Employees who had their retirement savings locked in Enron stock company policy watched their entire futures disappear. People in their 60s who'd worked for 30 years discovered their 401s were worth nothing. One Enron employee described coming to work the day after the bankruptcy and seeing colleagues crying at their desks. Not because they'd lost their jobs, because they'd lost everything. Meanwhile, the executives had cashed out. Skilling sold $66 million in stock before the collapse. Lay sold $70 million. Fasto made $30 million from the SPEs. They knew. They had to have known. The legal reckoning came slowly but thoroughly. Fasto cooperated with prosecutors, pled guilty, served just under 6 years of a 10-year sentence before his release. Jeff Skilling was convicted on 19 counts of fraud and insider trading, sentenced to 24 years. After serving over 12 years, he was released from federal custody in 2019. As of 2026, he remains a free man, his sentence having concluded. Ken Lay was convicted on 10 counts, but he died of a heart attack before sentencing. Because of the timing, his conviction was vacated. Legally, Ken Lay died an innocent man. And then there was Arthur Andersen, Enron's auditor, one of the big 5 accounting firms. The company that was supposed to be the check on Enron's accounting, the independent voice telling investors the numbers were real. They weren't independent. They'd been earning $50 million a year from Enron, $27 million in consulting fees alone. They had every incentive to look the other way. When the scandal broke, Andersen was indicted for obstruction of justice. Convicted. The firm collapsed. 85,000 employees worldwide lost their jobs. Though the Supreme Court later overturned the conviction on technical grounds, it didn't matter. Arthur Andersen was already gone. But perhaps the most lasting impact of Enron wasn't the bankruptcies or the prison sentences, it was the law that came after. In July 2002, President Bush signed the Sarbanes-Oxley Act. It was a direct response to Enron and to the wave of accounting scandals that followed in its wake. Sarbanes-Oxley changed the rules. CEOs and CFOs now have to personally certify their company's financial statements, not just sign off, certify, under penalty of criminal prosecution. Auditor independence was strengthened. Companies can't pay their auditors massive consulting fees anymore. The conflict of interest that corrupted Arthur Andersen is now illegal. Penalties for fraud were increased. Obstruction of justice, destroying documents, all of it now carries harsher sentences. And a new regulatory body was created to oversee auditors, to make sure the watchdogs are actually watching. The irony is perfect. Enron spent years calling itself the most innovative company in America. And in a sense, they were right. But their innovation wasn't in energy trading, it was in fraud. And their legacy isn't a new market or a new technology. It's a law designed to prevent anyone from doing what they did ever again. Here's what haunts me about Enron. The tools they used, mark-to-market accounting, special purpose entities, aggressive revenue recognition, these aren't illegal. They still exist. Companies still use them. What Enron did wasn't invent new crimes. It was take legitimate tools and push them past the breaking point. They took accounting techniques designed to provide flexibility and clarity and weaponized them to manufacture illusion. And they got away with it for years because they were good at it, because they hired the smartest people, because they told a story so compelling, so seductive, that everyone wanted to believe it. Wall Street wanted to believe because Enron was their golden child, the stock that kept climbing. Analysts wanted to believe because Enron gave them exclusive access, made them feel like insiders. Employees wanted to believe because their retirement depended on it. Even the skeptics, the people like Chanos who bet against Enron, they couldn't prove it was fraud. They just knew something didn't add up. The tragedy is that Enron's core business, the energy trading operation, was real, it was innovative, it created value. If they'd just run it honestly, if they'd accepted normal growth instead of explosive growth, they might still exist today. But they couldn't. Because once you start using imaginary profits to hit your numbers, you can't stop. The machine has to keep running. Every quarter, you need bigger deals, more aggressive assumptions, more creative structures. Until eventually you're not running a company, you're running a con, and every con has the same ending. On a quiet morning in 2006, the Enron logo was removed from the Houston headquarters. The building that once housed 20,000 employees stood empty. The trading floor where billions had been bought and sold was silent. Somewhere in that building, probably in a box in a storage room, there's a copy of Fortune magazine from the year 2000, America's most innovative company. They were right in a way, just not the way they meant. Enron didn't fail because its idea was bad. It failed because the story became more valuable than the truth. They weren't just counting chickens before they hatched. They were selling shares in the eggs, taking out loans against the feathers, and convincing the world the coop was made of gold. It was a confidence trick, built not in a dark alley but in glass towers, not by criminals but by the best and brightest, using not guns but spreadsheets. And the most uncomfortable question isn't whether it could happen again, it's whether it's happening right now. Because when you see a company with explosive growth, visionary leadership, a story that sounds too good to be true, and profits that don't quite turn into cash, you have to ask yourself one simple question. What are they actually selling? Sometimes the answer is a product, a service, real value. And sometimes the answer is a story, a forecast, a promise about a future that may never arrive. Enron wasn't an energy company, they were a story, and every story needs an ending. The question is whether you're still reading when it ends or whether you saw the plot twist coming.